Welcome to Management 101, brought to you by AG Consulting Group. Today, we embark on a journey to unravel the intricacies of strategic management, focusing on one of the most influential frameworks, Porter's Five Forces Model. Porter's Five Forces Model is a tool that empowers organizations to assess their industry's dynamics, identify opportunities, and formulate strategies to thrive. We will delve into each of the five forces that make up this model. The bargaining power of suppliers. This force centers on the supplier's capacity to influence an industry through control over critical inputs in terms of supply, availability, or cost. The bargaining power of buyers. This force evaluates the buyer's aptitude to negotiate advantageous terms and prices from industry participants. The threats of new entrants. This force appraises the prospective threat posed by new entrants venturing into the industry. The intensity of competitive rivalry. This force pertains to the intensity of competition prevailing within the industry. The threats of substitutes. This force scrutinizes the availability of alternative products or services capable of fulfilling analogous customer needs. There are 7 determinants that assess the strength or weakness of the bargaining power of suppliers. The first one is supplier concentration. When there are few dominant suppliers in the market, they tend to have more leverage and bargaining power. Conversely, when there are numerous suppliers available, their individual bargaining power may be lower. The second one is the differentiation of inputs. If suppliers provide unique or specialized inputs that are not easily substitutable, their bargaining power tends to increase as buyers may have limited alternatives. The next one is switching costs. High switching costs, such as significant financial investments, reconfiguration of processes, or loss of specialized knowledge, can weaken the buyer's position, and suppliers will have more negotiating power. The fourth one is supplier's importance to the buyer. If a supplier plays a crucial role in the buyer's operations or if the buyer heavily depends on the supplier for critical inputs, the supplier's bargaining power increases. The next one is the availability of substitutes. If buyers have multiple options for obtaining similar inputs from different sources, they can exert more control over the terms and prices offered by suppliers. The sixth one is the forward integration threat. Suppliers with the ability to integrate forward into the buyer's industry or market may have stronger bargaining power, giving them an advantage in negotiations. The last one is the cost structure of suppliers. If suppliers have high fixed costs or face cost disadvantages, they may be motivated to seek higher prices or more favorable terms to maintain profitability. The second force is the bargaining power of buyers. We encounter 7 determinants that gauge the strength or weakness of the bargaining power of buyers. The first one is buyer concentration. When there are few dominant buyers in the market, they tend to have more leverage and bargaining power. Conversely, when there are numerous buyers in the market, each individual buyer's bargaining power may be lower. Next is the buyer's purchasing volume. Buyers who make large and frequent purchases have more influence over suppliers as they represent a significant portion of the supplier's revenue. They can negotiate for better prices, terms, and conditions. Next is the availability of substitute products. The presence of substitutes gives buyers the option to switch to alternative suppliers, reducing their dependence on any specific supplier and enhancing their bargaining power. The fourth one is the switching costs. High switching costs, such as reconfiguration of processes, training, or integration efforts, can weaken the buyer's position. Buyers with low switching costs have more flexibility to switch suppliers. Next is the buyer's knowledge and expertise. Buyers who possess extensive knowledge and expertise about the product or service they are purchasing can leverage their understanding to negotiate better deals, thereby increasing their bargaining power. Next is the threat of backward integration. If buyers have the potential to integrate back into the supplier's industry, it can increase their bargaining power. Buyers producing the inputs themselves can give them more leverage in negotiations with suppliers. The last one is price sensitivity. Buyers who are highly price sensitive and have the ability to easily compare prices among suppliers have greater bargaining power, as suppliers must offer competitive pricing to attract such buyers. Now we move on to the next force, the threats of new entrants. The first determinant is the barriers to entry. The presence of barriers that make it difficult for new entrants to enter the industry acts as a deterrent, such as high capital requirements, economies of scale, access to distribution channels, proprietary technology, government regulations, or strong brand loyalty. Next is industry profitability. If the industry offers high profit margins, it becomes attractive to new entrants. Conversely, if the industry is already saturated with low profit margins, it reduces the incentive for entering. Next is differentiation and brand loyalty. Established companies with strong brand recognition and customer loyalty have a competitive advantage. New entrants may find it challenging to overcome customer preferences and trust with existing brands. The fourth one is access to distribution channels. Existing players may have well-established relationships with distributors and retailers, making it difficult for newcomers to gain market access. Next one is the cost advantages of existing players. If existing companies benefit from cost advantages due to economies of scale, proprietary technology, or preferential access to raw materials, it becomes challenging for new entrants to compete on cost. Next is regulatory and legal barriers. Industries having regulatory requirements, licensing procedures, or legal barriers can limit the entry of new players, as regulatory compliance or license acquisition can be time-consuming and costly. The last one is industry experience and expertise. Existing firms with accumulated industry experience and knowledge have a competitive edge. New entrants may lack the industry-specific know-how and relationships required to succeed. Now we move on to the next force, the intensity of competitive rivalry. The first determinant is the number of competitors. When there are numerous players vying for market share, competition tends to be more intense, leading to higher rivalry. The next one is the industry growth rate. In slow-growing industries, competitors often engage in fierce rivalry to capture a larger share of the market. When opportunities for growth are limited, companies must fiercely compete for existing customers, resulting in increased rivalry. Next one is product differentiation. When products or services are similar, competition becomes more intense. Conversely, when companies offer unique and differentiated products, rivalry tends to be less intense. The next is switching costs. High switching costs for customers can increase competitive rivalry. When it is difficult or costly for customers to switch from one company's products or services to another, companies compete fiercely to retain their customer base. Next one is strategic objectives. If companies have aggressive growth targets or a desire to gain market dominance, they are likely to engage in more intense competition, leading to higher rivalry. The next is market concentration. In concentrated markets where a few players dominate a significant market share, rivalry tends to be more intense as competitors vie for dominance. Conversely, in fragmented markets with multiple small players, rivalry may be relatively lower. The last one is exit barriers. High exit barriers in an industry, such as high fixed costs, specialized assets, or strong emotional attachments to the business, can contribute to intense rivalry. Companies may continue to compete fiercely even in unfavorable market conditions, leading to heightened rivalry. The last force is the threats of substitutes. The first determinant is price-performance trade-off, the extent to which substitutes offer better price-performance ratio compared to the industry's products. If substitutes provide similar benefits at a lower cost or offer better performance, the threat of substitutes increases. Next is switching costs. High switching costs act as a deterrent and reduce the threat of substitutes. When switching is easy and cost-effective, the threat of substitutes becomes more significant. The next one is availability and accessibility of substitutes. If substitutes are readily accessible and widely available, the threat they pose to the industry is higher. Next is customer loyalty and preferences. Strong brand loyalty and customer preferences can mitigate the threat of substitutes as customers may be less willing to switch to alternatives. The next one is perceived product differentiation, the perception of customers regarding the uniqueness or differentiation of the industry's products compared to substitutes. If customers perceive the industry's offerings as distinct and superior, the threat of substitutes diminishes. Next is industry-specific factors. Industry-specific factors such as regulations, patents, proprietary technology, or unique expertise may affect the threat of substitutes. Industries with strong intellectual property protection or specialized knowledge are often less susceptible to substitutes. The last one is price elasticity of demand, the responsiveness of customer demand to changes in price. If customers are highly price-sensitive and easily switch to lower-priced substitutes, the threat of substitutes increases. Thank you for joining us in this informative session. To stay updated with more insightful videos from us, make sure to subscribe to our channel and click the bell. You'll receive notifications whenever we release new videos. If you enjoyed this video and found it beneficial, we kindly ask you to give it a thumbs up and share it with others who might also find it valuable. Your support and engagement enable us to continue creating educational content. Thank you once again, and we look forward to seeing you in our future videos.